This is Nightly Business Report with Tyler Matheson and Sue Herrera. Funded in part by HSS.
Our value principles are patient first, and we want to deliver the highest quality care.
The goal of creating and sustaining value is all about putting the patient at the center of the equation.
The purpose of this organization is to help people get back to what they need and love to do.
Falling short. Stocks gain ground, but the Dow fails to hit the 20,000 mark again.
Last in line, think the rate you get on savings may go up as the Fed raises interest rates? Think again, it won't happen fast.
And pardon our appearance. Which airports do travelers think are in need of an overhaul? All that and more tonight on Nightly Business Report for Thursday, December 15th.
Good evening, everyone, and welcome. Not quite. Stocks rose today on Wall Street, and the Dow did have 20,000 in its sights, and then it didn't. Lifted early by economic data showing inflation is tame at the consumer level and manufacturing activity expanding for a 7th straight month. The Dow stood less than 50 points from 20,000, but then it got nervous. Happy feet. That's what they say when a quarterback gets jumpy in the pocket. Here's how stocks ended the day. The Dow rose 59 points to 19,852. NASDAQ climbed 20, and the S&P 500 was up 8.
Financial stocks continued their strong run today, benefiting from the Federal Reserve hiking interest rates yesterday. And while it's going to cost you more to borrow money right away, it might take you a while to see the upside of that rate hike in your savings account. Wilfred Frost explains.
The major banks have wasted no time in hiking their lending rates. All of the big names, including the likes of JP Morgan, Wells Fargo, Bank of America and Citi, have hiked their prime lending rate, most from 3.5 to 3.75%. Thus, banks have moved rates for borrowers both immediately and in full. The prime rate is what banks use to anchor floating rate loans, such as credit card loans and some mortgages. However, the increase for savers is slower and less full. This is especially the case at the start of a rate increase cycle because banks are still not super profitable. Therefore, the incentive for them to show price discipline now is higher than when rates and profitability are further along the line. This change is what they've been waiting for, so they're not in a rush to spoil it for each other. Who is the most geared to this? Well, it's banks with a higher proportion of deposit funding as opposed to wholesale funding, and within that, more small checking accounts rather than big savings accounts. On that note, Goldman Sachs research says that Bank of America has the most sticky deposit base because it has 60% retail deposit exposure. The likes of PNC, SunTrust, Wells Fargo and BB&T close behind. For Nightly Business Report, Wilfred Frost, New York.
When it comes to predicting U.S. economic growth and other measures, the Federal Reserve has missed its mark. According to the Wall Street Journal, for 5 years now, the Fed has overestimated GDP growth, inflation, and the unemployment rate. And for 5 years in a row, the Fed's forecast has been wrong. Joshua Zumbrun is a national economics correspondent who wrote about this for the Wall Street Journal, and he joins us now. Joshua, welcome. You had a very involved chart in today's paper. I'm not sure I understood it completely, but what I did understand was that the Fed doesn't seem to be terribly accurate when it predicts what the rate of inflation will be, what the unemployment rate will be, or what growth will be. Why do you think this is?
That's right. They've had a really tough time in recent years predicting what this economy would be like. And when you look at what the mistakes have been, they've been consistently making the same mistake over and over. They've been consistently saying that growth is going to be stronger than it's actually come in at. They've thought we'd get 4% or maybe 3% growth. We've consistently got about 2 or 2.5% growth. We've consistently come in lower than what they expected. So it's not just that they've missed repeatedly. You know, nobody has a very good track record predicting how the economy is going to perform. The interesting thing about what the Fed's done is it's missed repeatedly in the same direction.
So are they looking at the wrong data, or are they simply interpreting the data incorrectly or differently? You
know, I think there's been a lot of reasons that they've gotten this incorrect repeatedly. One of them is that they thought their own policies, I think, would be more powerful than they actually have been. You know, they thought holding interest rates near zero for this long, doing the kind of quantitative easing policies that they've done, they thought those policies would really give the economy a lift in a way that they haven't. You know, another factor is that they clearly underestimated the effect of U.S. demographics. They didn't realize how much of a drag there was going to be on the economy from the aging of the population. I think they'd admit that that's one of the things that they've gotten wrong here in recent years. And what's really interesting is that right now, the Fed is actually more pessimistic than the financial market. I mean, you've seen the Dow take off, and you've seen the dollar strengthen, and you've seen bond yields go higher, and everybody thinks there's going to be more inflation now. And actually, the Fed came out at their meeting yesterday and said they don't think that's the case. This time, the Fed is the pessimistic one. So, you know, they've been wrong repeatedly in the past, but they've always been too optimistic has always been the mistake. Right now, they're kind of the most pessimistic one in the bunch, and so it's a little curious what to make of that.
Quickly, are private forecasters, or are any that you know of, notably better at predicting these things than the Fed?
Everybody's had a very tough time understanding this economy in recent years. You know, private forecasters have made a lot of big mistakes too. We've seen a handful of predictions over the years that, oh, the U.S. economy is falling back into a big recession. We saw this in 2011 and 2012. It happened. That never really came to pass. We saw predictions of hyperinflation from some private sector forecasters. You know, that clearly was an extremely wrong forecast as well. So it's been a very tough time for everyone. What's interesting is right now the private sector forecasters are quite a bit more optimistic than the Fed.
We shall see how it turns out. Joshua, thanks very much. Very interesting article yesterday and today in the Wall Street Journal.
Thanks for having me.
Joshua Zumbrun with the Wall Street Journal.
Yahoo shares came under pressure today following a Bloomberg report that Verizon may look to get a better price or get out of its pending $5 billion acquisition of the company following yesterday's news of a second major Yahoo email hack, 1 billion accounts. Well, today, the White House said the FBI is now investigating the hack, which could wind up being the biggest data breach in history. Shares of Yahoo were down 6% to $38.41.
The news of the breach highlights the fact that your email account is in hot demand, but it's not just for the secrets in your messages, like I'll get milk on the way home. Andrea Day explains why the hackers are willing to pay top dollar for access and what you stand to lose.
When an attacker compromises your email account, his possibilities are limitless.
From cracking into your bank account to taking over social media.
Once an attacker gains access to your email account, he is you.
Omri Aluz is the CEO of Perimeter X, a cybersecurity firm that specializes in preventing attacks from bots. A bot is an application programmed to do an automated task, like sift through files only a lot faster than a real person can. And when it's used maliciously, it can target email accounts, cracking passwords in just seconds. It's called a brute force attack, and hacked email accounts are worth 10 to 20 times more than credit cards on the underground market. Here's why.
He can go and log into any account that you have by simply clicking on the Forgot My Password and getting a new password to your email. He can create new accounts by using your email and faking your identity. He can even gain access to private information that your bank might ask to do an online transfer. Ultimately, the attackers want to make money.
And he says you won't have any idea until it's too late.
You don't see anything. They take over your account. From there, they jump and they take over your social media accounts. Within an hour, they'll drain your bank account. They'll ship items from your stores, and they'll try to infect your friends.
So how do they get your password to begin with? This is a live attack dashboard where you can see bots cracking codes in real time. It doesn't take long, especially for common passwords.
Users use on average only 6 passwords throughout their entire online identity.
And using the same password for a bunch of different accounts just makes the attacks easier. The best advice is to pick a strong password and change it often. And in light of the recent Yahoo breach, even if your information wasn't stolen, you should watch out for any official-looking emails from Yahoo, especially ones that ask for a password. That could be a phishing scheme trying to trick you into clicking a link. Don't click on it. I'm Andrea Day for Nightly Business Report.
Well, joining us now with more on this is Eamon Javers. Scary stuff, Eamon. Andrea just described what the criminals are looking for, but there are a lot of different kinds of hackers out there.
Yeah, that's right. Andrew's talking about those criminals who are looking to profit by stealing your data online, get into your bank account, that sort of thing. But remember, what we've seen recently in the headlines are state-sponsored attacks, and that's what hit Sony Pictures Entertainment, for example, allegedly the North Koreans, and now allegedly the Russians hacking into the DNC and John Podesta's email. That's a much more sophisticated attacker. They have a lot more money, a lot more resources to deploy, and they're looking for different things ultimately.
Would a government-sponsored hacker ever want to come after me, a regular John Doe who doesn't work for the DNC or for the government or for a big corporation like Sony?
Well, it depends on who you know, who's in your circle of friends. They might look at you as somebody to get access to somebody else. And ultimately, what we're looking here at is the weaponization of privacy. What's happened to the DNC, what happened to John Podesta, is this idea of taking private information and then putting it out there in an embarrassing way. The Russians call it kompromat, for compromising material online. They call it doxing, and it actually does happen to regular people fairly often throughout the internet. And one of the many dangers here, it seems to me, of all this recent hacking that we've seen is that this idea takes off and we see a lot more doxing of regular people. You know, if you're a school teacher in a small town and somebody gets into your private email, maybe there are things in your email that you wouldn't want your students or your employers to see. That kind of thing could really take off in the wake of the success of the hacking of the DNC, as a lot more people look at this and say, here's a way to get back at my enemies.
All right, Eamon, we'll leave it there. Thank you very much. Eamon Javers in Washington.
Tom Wheeler, the chairman of the Federal Communications Commission, will step down January 20th. That will give the new president a GOP majority at the FCC on his first day in office. The move also paves the way for potential policy reversals, including one involving so-called net neutrality, which forced broadband providers basically to treat all internet traffic equally.
The president-elect wants a bump in infrastructure, and airports are in his sights. Coming up, which terminals are in good shape and which could use a facelift. The nation's home builders are suddenly feeling the best they have in more than a decade, which is kind of surprising given rising interest rates. Diana Olick explains why the unexpected swing.
Home builders haven't felt this confident since before the epic housing crash of the last decade. A monthly sentiment of builder confidence in December took an epic leap, all thanks to optimism for Trumponomics.
I think there's a great deal of post-election euphoria. The women and men who make up the home building industry have been burdened by excessive regulation for a significant portion of the last 8 years. They're looking forward to the new administration coming in and living up to its promises that they're going to repeal and roll back a lot of the regulation. And I think that's something that the housing sector could very definitely use.
Confidence rose to the highest level since the middle of 2005. It's the first read since the election and the largest one-month gain in 20 years. Last December, confidence was decidedly lower. Builders said they saw big jumps in current sales, and their expectation for sales over the next 6 months was even higher. Buyer traffic through new model homes, which has been in negative territory, finally moved to positive on the survey. All this despite the fact that mortgage rates shot up after the election and continue to move higher daily.
Most of the builders have been around long enough that 4.5% mortgage rates are still viewed as pretty reasonable. Maybe to some of the millennium first-time home buyers, it will be an incentive to motivate them to get into the market sooner.
That may be a little over-optimistic. Just ask investors. Stocks of the big builders knee-jerked higher after the report was released in the morning, but quickly moved lower despite the broader market rally. And deregulation may help builders, but stricter immigration could hurt them.
We do think the builders are too optimistic given the still high costs they have for land and tight labor supply in many markets.
Builder optimism is one thing, but so far it hasn't translated into a similar move higher in home construction. The two used to move in tandem, but in this historic housing recovery, the hope has gotten ahead of the house. For Nightly Business Report, I'm Diana Olick in Washington.
Facebook takes aim at fake news, and that is where we begin tonight's Market Focus. The social media company will team up with some media organizations to be third-party fact checkers. Facebook said it will target the worst of the worst, peddlers of fake news, and hopes it will make it easier for its nearly 2 billion users to spot and report the imposters. Shares of Facebook rose a fraction to 120.57. General Motors will begin to test its autonomous vehicles on public roads in Michigan immediately. CEO Mary Barra said the automaker will also begin to produce the next generation of self-driving cars early next year. GM was up 29 cents at 36.24.
Waste Management is buying back up to $750 million worth of its shares. This replaces its previous $575 million buyback. Company is also raising its quarterly dividend by nearly 4% to 42.5 cents per share. Shares of Waste Management tacked on 6 cents to $70.10. Pier 1 surged today following its strong third quarter results, which were out late yesterday. The home furnishings retailer saw e-commerce sales rise 28%. The company's CEO told investors that sales trends rebounded in the second half of November as its seasonal assortment resonated with customers. Shares rose 32% to $8.57.
Okay, folks, here's something that may surprise you, especially if you've been frustrated when flying recently. A new study finds that customer satisfaction with America's airports is at an all-time high. This comes even as President-elect Trump promises to rebuild terminals and hubs he describes as looking like something out of the third world. Phil LeBeau has more.
Admit it, you don't like spending a lot of time at an airport. Between long security lines and growing crowds, most of us just want to get on a plane and get out of town. But a new survey shows people are actually happier with their airport experience.
The airports are improving themselves. Those improvements they had in hand and on the drawing boards before 9/11 back in 2001 were kind of put on hold because of a lot of security concerns and just other things that the airports were having to do to accommodate new security regulations. And so those plans are now being actually carried out.
New restaurants, shops, and spruced-up terminals are becoming more common at airports. According to J.D. Power, Portland, Tampa, Las Vegas, Orlando, and Miami have the highest satisfaction scores. By comparison, some of America's oldest airports are rated as the worst. That includes New York LaGuardia, Newark Liberty, Philadelphia, and Chicago O'Hare. Those airports face greater congestion as they add flights and millions of travelers who put extra strain on old terminals and gates. It's a problem President-elect Trump hopes to solve by spending $1 trillion on America's aging infrastructure, including rundown airports.
We're going to rebuild our infrastructure, which will become, by the way, second to none.
Some airports like LaGuardia are being renovated, but for others it may take some time before there is a full makeover. In the meantime, millions of travelers are going through old airports and really not minding what they're seeing. Phil LeBeau, Nightly Business Report, Detroit.
Well, since infrastructure will be important to the next administration, our next guest has the names of some stocks that he says belong in your portfolio. He is Stanley Elliott, construction materials and machinery analyst over at Stifel. Welcome. It's nice to have you here, Stanley.
Hey, thank you for inviting me.
So are you looking at international companies, domestic companies? Where do you see the most potential?
Right now, we see the most potential on the domestic names. Names that would provide materials into the infrastructure space. We're a little more cautious on some of the capital goods, although we do think that 17 should mark the bottom for many of those capital goods names.
So let's delve in here a little bit. When you say capital goods, I assume you mean some of the big heavy equipment manufacturers like Caterpillar. Your choices in the space are materials suppliers, companies that help with concrete and aggregates. Name a couple of the ones you like.
Sure. So Vulcan Materials is a name that we like right now. Martin Marietta, Summit Materials, and U.S. Concrete. All of those companies own aggregate quarries, own cement plants, asphalt plants, and ready-mix concrete plants. We think 17 will set up to be a very good year for them.
In terms of how long you think it will take before some of these stocks get the bump to the upside, I mean, obviously, if you look at Summit Materials there, on a one-year basis, it's up 24%. Do you think there is significant room to run still in these stocks? Obviously,
We do.
you like them, but...
We do, actually. So when you think about 17, the way the demand picture sets up from a volume perspective, we're looking at fairly easy comparisons because of some weather disruptions earlier this year. Another thing to think about is that the funding environment has improved both from the FAST Act, which is a 5-year bill passed about this time last year, as well as higher state and local spending levels. Lastly, we'll talk about on the pricing side of the equation. This is an industry that's been able to push pricing through as well. And then on the cost side, costs are favorable. So we expect another record year of both profitability and revenue growth for all those companies.
You know, let's assume there is a large infrastructure effort that comes out of Washington in 2017. These things play out over a period of years. Do you expect, usually, do you expect that some of those capital goods companies might benefit in what they used to call the out years downstream?
Yeah, absolutely. When you look at, let's say Caterpillar, for example, 2017, the company's already spoken to the fact that that will be down on a revenue year basis. But if you go back to the 1920s when the company first became public, it has never had 5 consecutive years of down revenues, which is what we're looking at right now. So with a number of the mining markets, energy markets, hopefully bottoming, plus a little bit of a boost from a construction, we think that the outlook for that company going forward should be pretty good as well.
All right, Stanley, thank you very much.
Great,
Stanley
thank you very
Elliott
much.
with Stifel.
Coming up, when it comes to investing, millennials may be starting to shift their mindset. We'll tell you what that could mean.
The photo-sharing app Instagram says it now has 600 million monthly active users, doubling in size in just 2 years. Facebook bought Instagram in 2012 for $1 billion.
Well, as the Dow approaches 20,000, more and more investors have wanted to get into the game and ride the wave of the so-called Trump rally. And as Aditi Roy tells us, one highly sought-after group may be changing its attitude toward investing.
When Donald Trump won the election, 27-year-old Nick Cinquino made changes to his stock portfolio.
I've changed my individual stock plays. I held a lot of solar, so I had to adjust for that, and I kind of took that loss as soon as Trump won the election.
He isn't the only millennial watching Trump and his pocketbook. Ruchi Shah is more cautious.
I was not sure what will happen, so I'm right now in wait and watch mode and then thinking what to do.
Unlike Shah and Cinquino, most younger Americans don't invest. A recent Bankrate survey found only 1/3 of millennials invest in the stock market. But that doesn't deter companies like Robinhood. The Palo Alto, California-based investment company targets millennials by operating on a mobile-only stock trading platform. 90% of its clients are under the age of 35, and the firm, which has 1 million users, says it's noticed a significant uptick in investing since the election. The company reports the day after the election was its biggest transaction day. Transaction volumes increased more than 90%, and new accounts grew by 71%. In the week after the election, Robinhood transacted more than $1 billion through the platform, up 50% from the week before. Robinhood isn't the only millennial-focused investing platform seeing an uptick. Stash allows its users, whose average age is 30, to invest as little as $5 in fractions of ETF shares. It's seen a 30% increase in daily inflows since the election. And Acorns, which allows users to round up everyday purchases and invest the spare change in portfolios, tells us that it has seen an increase in user accounts after the election, but that uptick is consistent with its month-over-month growth rate. These millennial-driven services face a big challenge. 2/3 of millennials have less than $1,000 in their bank accounts, according to a 2016 Go Banking Rate survey. Still, Robinhood's co-founder says he believes the company's post-election momentum could be just the beginning.
I think there certainly is a coming of age of the millennial demographic to be a part of the economy, right? Like this is, I think 2015, 2016, 2017, 2018 are going to be the first years that a lot of these new consumers are going to have their first few hundred or a few $1,000s to save.
Even as millennials like Jake Lowenheim say they're not changing their portfolios one bit.
Kind of learned a long time ago that things are cyclical and they kind of go on their own. Not big ways to move a needle just based on a political movement.
While it remains unclear whether this uptick in transaction volume will continue, the folks here at Robinhood are hopeful that they will be able to capture some of the vast financial potential of millennials, a group that some experts estimate will have $8 trillion worth of global net annual income by the year 2025. For Nightly Business Report, I'm Aditi Roy, Palo Alto, California.
No doubt 20,000 today.
That's right.
I'm betting on the 30th of December.
Are you?
That's my bet.
A year end. Okay, we'll see. You heard it here first.
And that's Nightly Business Report for tonight. I'm Tyler Mathisen. Thanks for watching.
And I'm Sue Herrera. Have a great evening, everybody. We'll see you tomorrow.
Nightly Business Report has been funded in part by HSS.
Our value principles are patient first, and we want to deliver the highest quality care.
The goal of creating and sustaining value is all about putting the patient at the center of the equation.
The purpose of this organization is to help people get back to what they need and love to do